Welcome back in. It's Money Tuesday, and while the markets were up yesterday as we enter the final quarter of the year, there's obviously still some uncertainty because of the pandemic and, of course, the outcome of the election. A lot of that is out of your control. So what should you focus on that you can control? Marshall Clay from the Welch Group joins us this morning with some financial advice for you. Good to see you this morning, Marshall.
Hey, Mike, how are you?
Doing well. Well, let's first talk about, because we're getting close to the end of the year. And some things we should do would maybe take advantage of our tax situation. What should we do with that? How should we approach that?
Yeah, so I think you mentioned it at the outset. I mean, it's about controlling what you can control. I think we spend a lot of time talking about COVID-19, results of elections, et cetera, but those are things that really are outside of our control. And tax efficiency is really an area that I recommend people focus on, at least for the balance of the year, and if not beyond. And one of those areas that we execute for a lot of our clients is what's called tax loss harvesting. So what that involves is if you have a taxable accounts, this doesn't apply to retirement accounts, we're talking about taxable accounts, looking to sell any positions that you have in your portfolio that may be at a loss. I mean, we've had a little bit of a rough year in the stock market. Some people probably have some positions in their portfolio that are at losses. So selling those positions, leaving those positions sold for at least 31 days. If you want to buy those positions back, fine. If you don't, that's fine as well. But realize those losses, because what those losses are going to allow you to do is counteract maybe some other potential gains in your portfolio. And if you don't counteract those gains, you can actually deduct up to $3,000 against your income.
All right. Meanwhile, for charitable giving, it's become more of a standardized deduction, and you certainly would hope that people would give, out of the goodness of their hearts, first of all. But talk about the advantages you need to look for in terms of charitable giving, and how should you approach that strategy?
Yeah, so there are a lot of appreciated positions in people's portfolios this year. I mean, the technology sector is a great example of that. And I think if people have a charitable intent, I mean, that's kind of first and foremost. But if you have a charitable intent, look to give appreciated stock versus giving cash. It allows you to do a couple of things. One, it allows you to avoid realizing any capital gains that you would have to pay taxes on if you just sold those positions in order to free up cash. It also accomplishes your charitable intent, but then also it allows you to maybe jump and leap out of that standard deduction category and move into an itemized deduction where you can get a bigger benefit for those gifts.
All right, we only have about 30 seconds. Roth conversions. Talk briefly about what you mean there.
Yeah, so this is a little bit complicated. It's really you're voluntarily deciding to move money from a traditional IRA, pay the tax early, and move that money to a Roth IRA. It's really for people who think that they're in a really low tax bracket year here in 2020. Maybe their tax brackets may actually be up in future years. It's just a way to get money from a tax deferred account to a tax-free account moving forward. And it's just a better long-term play for a lot of people. So I would advise people to consult their financial advisor or tax accountant for that.
All right, Marshall Clay from the Welch Group. Thank you so much for that information. We know that's going to pertain to just a certain segment of our viewing audience, but it's helpful to those folks, so that's why we want that information out there. Thank you, sir.
Yeah, absolutely.
All right, still ahead now, why Coke is getting